The ground is cracking under gold right now, and almost nobody is watching the right level. You are staring at a $200 trapdoor, and the trigger is one single number, 44.92. If that number fails, the whole structural bull case that has carried gold for months gets its first genuine death test. I have 3 exact trade plans mapped out, and I am giving you the entry, the stop, and the targets. Stay until the end because the third setup is the one the aggressive money will use to scalp a panic flush, but it can destroy you if you blink. Right now, I need you to understand what this price action is really saying. Gold is at 4,509, down hard, and the sell signal is screaming on the 1 hour, the 5 hour, the daily, and even the weekly chart. But here is the trap. The monthly time frame is still printing a strong buy. That contradiction is where fortunes are made and lost this week. Right down 44.92. If we break it and hold below it, you are looking at a structural reset that drags price into the 200-day moving average at 43.74. That is your danger zone and your hidden opportunity all at once. Here is the instant market verdict for this session. We are in a hard fading market. The bias is aggressively bearish below 45.75. Every pop toward that zone is a sell until proven otherwise. The invalidation level that would kill the bear case today is a 4-hour candle close back above 45.75. If price recaptures that level with volume, the selling pressure is exhausted and we flip to a range. Bound consolidation or a squeeze higher. But right now, sitting at 45.09 and holding below the MA5 at 45.35 and the MA10 at 45.57, the path of least resistance is down. I want you to type that invalidation number in the comments now. 45.75. Write it down. If we close above it, the whole thesis changes. That keeps you disciplined. Now let's walk the chart from the top timeframes down, because the battle here is a war between the monthly trend and the weekly collapse. The monthly picture is still a series of higher highs, and the MA200 on the monthly is miles below. That has kept the structural bulls confident. But here is what most traders miss. The weekly chart has just printed a decisive sell signal. The MACD on the weekly is rolling over into negative territory, and price has sliced through the weekly MA20 like it wasn't even there. That divergence is a massive warning. When the weekly trend fights the monthly, the short-term pain usually wins first before the long-term trend can reassert. The daily chart is even uglier. The daily trend is a strong sell, no ambiguity. The daily MACD is deep in the red at minus 40.93 and still accelerating. The RSI at 40 is not oversold, meaning there is plenty of room to fall before any kind of exhaustion bounce. Price is trading below every meaningful daily moving average. The MA20 at 46.05 is a ceiling. The MA50 at 46.78 and the MA100 at 46.38 are distant resistance zones that are not even in play for a bounce today. The only moving average that matters right now as a downside magnet is the 200-day MA at 43.74. That is the brick wall where structural buyers are likely hiding. But the distance between 45.09 and 43.74 is roughly $135, and there is a vacuum in between. That vacuum is where a breakdown accelerates. Now let's drop to the 4-hour and 60-minute timeframes to find the trapdoor. On the 4-hour, the MA20 is sloping down sharply and sits at 46.05, perfectly aligned as dynamic resistance. The MACD on the 4-hour is showing no bullish divergence yet. Sellers are in full control. On the 60-minute, the picture is identical, strong sell, price capped under every short-term moving average. The 1-hour MA5 is at 4,535 and is acting as the immediate ceiling for any intraday bounces. The 1-hour MA10 at 45.57 is the next layer of resistance. These are your active trader sell zones. The key horizontal support right in front of us is 4,492. That is a structural floor that has been tested before and held. Below that, 44.49 is the next pivot. And if both of those snap, you are staring at a straight shot to 4,400 and then the 200-day MA at 43.74. The resistance overhead is equally clear. 45.75 is the first major zone that must be reclaimed to even think about a recovery. 46.15 is the second. So the technical narrative is brutally simple. Bulls must hold 44.92 and push back above 45.75 to regain any credibility. Bears just need one strong candle closing below 44.92 to trigger a cascade. And right now, the momentum is squarely with the bears. But there is a crosser-set thread that makes this even more dangerous. Crude oil is flashing the exact same disinflationary message. Oil has been unable to hold its own geopolitical premium, and that breakdown is confirming a broader commodity unwind. When gold and oil fall together, it is not a risk-off safe haven bid anymore. It is a real yield surge and a liquidity squeeze. The dollar index is holding firm, and real yields are ticking higher, which historically crushes gold. The fear architect role that gold plays only works when inflation expectations are running hot and geopolitics are on fire. Right now, the market is pricing out the geopolitical panic and pricing in a return to a hawkish macro environment. That fundamental driver is exactly what that headline yesterday was probing. Gold consolidation tests whether the structural bull case still holds. The last 24 hours have shown that central bank rhetoric is tilting less dovish, and there is a palpable sense that the gold buying frenzy from earlier months is pausing. Unless we get a fresh geopolitical shock or a sudden dovish pivot from the Fed, the 1 to 2 week directional lean is lower. The event that would invalidate that bearish lean is a sudden breakback above 46.15 on a daily close. Until then, rallies are selling opportunities, not bull traps. Most people will skip this part, but this is where money is made. Keep watching. I am giving you 3 precise trade setups, and I want you to engage right now. Type your gold range for tomorrow in the comments. Put your low and your high. I am reading them, and it shows me how aligned we are. First setup is the sniper, the conservative play. This is for traders who want the highest probability entry on a confirmed breakdown. The trigger condition is a 1-hour candle close below 4,492 with strong volume, followed by a retest of that broken support as new resistance. You wait for price to come back up and stall at 44.92. The entry is a sell limit at 44.92. The stop loss goes at 45.17, just above today's intraday rejection high. The logic is simple. If price recaptures 4,492 and pushes above that swing high, the breakdown has failed and we stop out. Target 1 is 4,449, which is roughly a 1 to 2 risk-reward ratio. Target 2 is 4,400, stretching to a 1 to 3.5 risk-reward. If price moves in your favor, move the stop to break-even once 44.70 is touched. This setup is voided if we never get the retest or if the breakdown candle is a low-volume wick. The sniper waits for confirmation, not anticipation. The second setup is the active trader, the standard approach for those who want to sell into strength and ride the bearish momentum without chasing breakdowns. You are waiting for a mean reversion bounce into the 1-hour moving averages. The entry condition is a sell limit at 45.55, right at the convergence of the MA10 and the top of the recent consolidation micro-range. The stop loss is placed at 4,577, just above the 4,575 resistance zone, giving you a $22 stop. The logic is that if price can push through 45.75 and hold, the bearish structure is broken intraday and we want out. Target 1 is 4,510, capturing the flush back to the current zone with a 1 to 2 risk reward. Target 2 is 4,460, extending toward the next support with a 1 to 4 risk reward. Once target 1 is hit, trail the stop aggressively to 4,540 to lock in profit and let the remainder run toward 44.60. This setup capitalizes on the fact that sellers are reloading at every moving average resistance. It is high probability as long as the daily bearish structure holds. Now the third setup, the aggressor, is for the high-risk traders who understand that a momentum crash through 4,492 can print money in minutes but can also whip them out. This is not for the faint-hearted. You are looking at a 5-minute chart breakdown. The trigger is an impulsive 5-minute candle closing below 44.89. breaking the 44.92 support with speed and no hesitation. Enter short on the very next candle open at market. Your stop loss is brutally tight at 45.06, just above the pre-breakdown consolidation low. That is a $17 stop. Target 1 is 4,460. Target 2 is 4,440. The risk-reward on target 1 is roughly 1 to 1.7. On target 2 it is close to 1 to 2.8. The warning here is explicit. Only take this if you can handle a sudden reversal and you never risk more than a fraction of your normal size. The 5-minute chart can fake you out, so if the candle that breaks 4,492 reverses and closes back above within 2 bars, cut it immediately. This is a scalping ambush, not a swing trade. It exploits the vacuum we discussed earlier. The moment panic selling starts, the algorithms chase it lower, and you want to be on the right side. Now, before I give you the risk management pulse and the critical level for tomorrow, let me say this. Never risk more than 1 to 2% per trade. No positions through high-impact news. Stops are non-negotiable. If 44.92 breaks and you are short, respect your targets, take partials, and never marry a trade. So what is the one critical level for the next session? It is still 44.92. That number decides everything. A daily close below 4,492 opens the trapdoor to 4,449 and then 43.74. A close above 4,575 throws the bearish script out the window and sets up a vicious short squeeze. Tomorrow, I will be watching the follow-through and the new fundamental catalyst that could either accelerate the collapse or spark a mean reversion rally. The structural bull case is on trial, and the verdict is near. Now here is what you do next. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen. The risk asset shadow is showing a disconnect that will lead to a major move, and I have the exact levels mapped. Smash the like button if this gold analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one.